Welcome to a podcast here. I'm here with Jade Bennett from Electo Finance. How are you, Jade?
I'm good, thanks. How are you?
Yeah, very well, very well. Now, reason for the conversation is all things finance. Being a lender, broker, do you want to give us a bit of an insight into your world?
Yeah, absolutely. So I am one of the brokers with Electo Finance. I am based in the city, but we do cover the whole of Australia. So here today to have a chat with you, Anne, just around what you're seeing in the market,
Great.
you know, how that's affecting your buyers, and then also how I'm seeing it from my perspective as well. So
Awesome.
that way we can, see what's happening and where the opportunities are.
Sounds great. It's always good to get two perspectives because certainly we're dealing with the buyers and they need to borrow money. And that's where, brokers and lenders are very, very important. So, look, in terms of the RBA, I want to ask you, how soon are they going to be dropping, and what's your prediction?
So they are going to be meeting again on the 17th and 18th of February. Yeah. I think everyone in Australia right now is holding their breath for that meeting. Yeah. Really looking good though. So we have now got all four of the big banks that are forecasting a drop, which is huge.
Great.
Like, that just shows the confidence that they've got.
Yep.
They are dropping their fixed rates left, right and centre. We're seeing a lot of that come through, and the kick on from that is only going to be drops in variable rates as well. So I reckon we're set for a drop. Yeah, 100%. Awesome. As to how that will affect someone though, so I think the misconception a little bit around this is that people are thinking rates are going to drop. Great, we're going back to our 3%. It's not going to be the case.
We'd love to see that, but some people, yeah.
Absolutely. I think, look, we probably are going to have maybe 2 to 4 drops in the coming year.
So quarter
to 2
percent
years.
Or 0.5%, you reckon?
I reckon quarters, and I think I think the new normal now for Australian rates is going to be in that 5s and 6s, Okay. I don't think we're going to be anywhere near where we used to be, although we'd all absolutely love that for all of our properties. But I just think that's going to be the new normal now, and it's what we need to get used to.
So for the layman's out there, if you're at the moment, what's the best fixed interest rate at the moment?
Well, there's been quite a few drops, as I said, lately. So they are coming out with 5.4s for fixed. Mm-hmm. I wouldn't be fixing right now, personally.
Variables? Where is it at the moment?
We're still high. So we're still, 6s, sometimes 7s, obviously dependent on the person's circumstances and how much they've borrowed against their property. So LVR.
Yep.
And that's loan to value ratio, if you don't quite know what that is. So I think we'll have little drops. It's not going to be the huge effect that people might think it will be, but
it'll get things moving
absolutely
positively.
Yeah.
We certainly saw. I know for us selling in the COVID period when the cash rate or the RBA had their cash rate at a real all-time low, and people were stocking up, and now they've come out from a fixed interest rate, say 2.5%, to now the variable at 6.5%. That has certainly impacted their way of living. So have you seen many like that at the moment, like with your clientele? I'm sure you've...
Absolutely, yeah. So we've had quite a few. I just recently did a refinance whereby, and they were with one of the big four. You'd expect a bit of loyalty help, maybe. You'd expect that from the big four, and these clients had come off a fixed rate, 2.9%.
Yep.
They were living life. While everyone else was struggling.
And to give it into context, like, say mortgage-wise, they were borrowing, what are they sort of, would it be a couple thousand, like 2,000 or 3,000 that their mortgage repayment was? And then when it increased, what was the difference?
Yeah, it was huge. So they then came off that fixed rate at like 2.9%, and it reverted straight back to 8.9%.
Wow.
Which is huge. And this is why people need to be on top of their loans and check in regularly, because it was only my call to them, because they were already a current client. I knew that was coming up. That prompted them to actually look, and they had no idea that they were going.
Jeez.
They were expecting maybe a 5 or 6%. But
and
the
jumped.
sneaky banks, and they've just got those revert rates so high because they want people to not notice. They want people to just keep on paying and think, oh my God, this is going to apply, but I'm not actually going to check or do anything about it. So because we were on the front foot, we refinanced them out straight away.
Yep.
They are now low sixes, which again, variable. We're waiting
Still
for
very
the drops.
good. Yeah.
Exactly.
Yeah.
In that climate.
Better than the 8.9%. So,
Yeah.
I mean, to put it in context, on an average loan, so like medium price in Melbourne's just, you know, hovering just under 800,000. So the average loan, would that be $500,000 or 600,000? What would be the average loan?
It really depends. I think in Victoria, the average, I'm just going off the top of my head now, but I do think it's in those 600,000s. For me, it is a little bit higher, only because, again, I've got some of those investor clients.
Sure.
But yeah, so it really depends on the person, on your, I guess, your clientele and things like that.
Yep.
But I think the main thing, it's working within those LVRs, that loan to value ratio, like how high is that? Because that really does affect your rates as well. So if you're only at, you know, a 50% LVR, then you're getting the best that the banks have got. But if you're 80, 90, 95 in some cases percent LVR, then they're going to hit you.
They're going to hit you hard.
Yeah.
And look, we've certainly seen, I know from that, and we're talking, you know, there's a couple of markets that we work within. So the lower end market, the first home buyer, sort of between that, you know, 650 to 1.25, the market's going pretty well in that sort of bracket at the moment. Anything above that 125, we've seen, you know, in 2022, properties in certain areas were at a high price. Those buyers now, though, unfortunately, that bought at a high price, they were also leveraged quite high.
Yeah.
As soon as they came out of a fixed interest rate to a variable, the increase in payments was nearly double what they were paying. So what we're seeing is there's been, and even borrowers, you know, people that could borrow $1 million only a couple of years ago, we have a little brochure we show our clients that some of that same buyer on the same wage, exact same terms, cost of living as what it was last year, they can only borrow not $1 million but 600,000. Yeah. So the banks are certainly tightened. Would that be fair to say? Like they've tightened
100%, and it's happening across the board as well. Like you're 100% right. You know, people aren't able to borrow what they thought they could borrow, and for those that did wait and didn't necessarily, you know, jump on something straight away, I think they're feeling it the most. Yeah. And just those mortgage repayments, you know, it hurt a lot of people. Yeah. It has been hard, I think, for a lot of people, but hopefully over the next year there will be a little bit of relief to that. Yeah. I guess, you know, when you talk about your first home buyers, though, they have the monopoly right now. Like
they do, don't they? Yeah.
They 100% do.
Because you've got the great thing about first home buyers, if they're partnering up and they're being a lot smarter because they're partnering up. So you've got two incomes coming in versus one. So they seem to be really in that market's really bubbling along nicely. It's strong. Yeah, the market's strong, especially with the government incentives at the minute. So right now, for a first home buyer, no stamp duty. So there's 30 grand straight away. Fantastic. On, let's say, so 600 grand house. It used to cap at a certain price. Yeah. So you're saying it's no longer? As long as they fall within the income bracket. So 120,000 income for the year for an individual, 200,000 for a couple. Okay. They're able to not pay that stamp duty amount. Fantastic. Now, the other thing is, it's funny because I was just saying before how the LVR, the higher you are, it's not a good thing. But this is again where those first home buyers are benefiting, because the government have basically got this scheme out there where first home buyers can put in a 5% deposit, so borrow at that 95% LVR, but the government is guaranteeing that 20%. So what the government are doing, they're saying to the bank, okay, so instead of making that client get lender's mortgage insurance, which again, it's a great tool, when it needs to be used, 100%, I'm all for lender's mortgage insurance. But the government are saying to the banks, all right, don't go putting that lender's mortgage insurance on those first home buyers. You're making it harder for them. It's more money they don't have. We'll guarantee that amount. And by doing that, the banks are then giving those first home buyers that 80% LVR rate. Okay. So instead of having the really high 90, 95% LVR rates that are out there, they're getting them at a lower. They're getting the rates as if they've got that 20% cash deposit, which they don't. So does the government get So if they say in a few years' time that first home buyer decides to sell, is there a catch there? Is there a payment back to the government or?
No, there isn't.
Okay.
So, well, there's two schemes. So there is another scheme that you can look into where, so they're better for different things. So if servicing's your issue, as in how much you've got money per month to pay that loan, then there's another scheme whereby the government will actually purchase equity in your house.
Okay. Yep.
So what that does is it reduces your monthly repayments because your part of the loan is only for that smaller amount, and the government have got, let's say, 15% equity in your home, and they're essentially covering that. So they're buying a part of your house.
Okay.
So that's...
And what's that scheme? I must say I haven't really come across it. I heard of that. That's why I wanted to ask you that. Have you seen many of your clients use that or?
No, look, I'll be honest, no.
Yeah.
Because, and not that it's a bad thing, you know, like I said, different things for different people.
For sure.
If servicing's your issue, that could be a really great way to still get into the market. For a lot of my clients, it's more servicing's fine. It's having that cash money spare to put in for the deposit, and that's where the other scheme comes in. So with the home buyer guarantee, the 5% deposit, the government don't own that equity.
Okay.
So all they're doing is guaranteeing that. It's basically like an insurance policy. So they've got no stake in your house. Well, when I say they've got no stake, like they don't own a part of your house.
Yep.
They are still guaranteeing that percent for the bank, and that's just to cover you, essentially. It's like an insurance policy.
Yeah.
But once you know, the property grows, maybe you do some renovations, your property value increases, that LVR decreases. Once the LVR is below 80%, the government, they're no longer part of that. They're no longer guaranteeing it because they don't need to, because you're back at that acceptable loan to value ratio. Sensible,
so that and it's interesting when people, you know, I know when I first got into real estate, I wasn't sure with the LVR, and I didn't know all of those little intricate details. So when people were trying to, sell their place and get a deposit, and the banks are like, oh, sorry, we can't, and the owners are like, oh, we've got the money. It's crazy how things can work out, but
absolutely. And that's where I guess like things like deposit bonds and stuff can be really great tool to use. Would you have experienced that much?
We don't, because we do a lot of auctions. We tend to find, like last year, I think we did the 30, just under 40 transactions, and 3/4 of them were auctions. So what we find is when it's an auction, money has to be transferred. With first home buyers, I have seen a few that have been using that deposit bond, but it tends to be a domino effect. So if you've got an elderly person who needs that money to move into retirement, if there's a deposit bond, we've had some buyers and we've said, sorry, you can't do it because the owners need to access the funds to be able to pay their carer or the nursing home they're going into. So have you seen many, how many transactions are you seeing with deposit bonds?
Where I tend to see them is when, like you just said, they're in a property, you know, they're selling that property, they're buying another one, so they don't have their deposit yet, but they need something for the next one. They've not necessarily got those cash funds sat ready around waiting for that. So again, it's a tool. It can be really useful to some people. I've actually had someone use one for one of the properties that I was selling, and it's a smooth process. Again, it's essentially an insurance policy.
An insurance policy,
And so they've got that cost up front. I think a lot of them cost around $1,500 to $2,000, dependent on the property value usually.
Yeah, great.
But it just, it's another tool where people can get into properties quicker if they need to, and not have to worry about having all that cash money.
All that cash, And look, let's be honest, there's a lot of people that I'd say 80% of people will have all their money tied up in their biggest asset, and often we'll talk to sellers that will be saying, look, we need to sell first, and we want to, once we know what we're going to buy, once we know what we're going to sell for, we can then look at the money that we've got and then look at purchasing. We have instigated talking to whether they've got their own broker or talk to someone to make sure that they have that money accessible, because sometimes it can mean the difference between them getting a property or not, because you just got to know what the clientele is doing. So
And it's hard as well because I know personally I've had clients come to me, and I think this is where, financial literacy isn't everywhere, and there's a lot of people that don't necessarily know what they do. They know what they want and they work really hard in their chosen field, but they don't have that background knowledge to fully understand the process. I've had clients come to me and say, "Oh, Jade, I'm going to go and put an offer in on this property." No idea about, subject to finance or anything like that. So that's my biggest thing straight away. I'm like, make sure you say subject to finance. I'm like, oh, what does that mean? I'm like, it means that we've got an out if you can't.
It's interesting. It's a conversation I've said through many, people that I know. Often at school, we don't learn those things in terms of just the day-to-day basics. The day-to-day basics. So when you are buying, having your pre-approval, all the checklists. So that's something that I'd love you to sort of, explain to me. Like if, say I was a first home buyer, coming to you and I'd say, Jade, look, I'm here. What do you need from me to be able to get me where, in a position where I can start making offers, and of course putting subject to finance on the contract? What would you need from me to facilitate that?
Well, I'll just start by saying that these are my favourite clients. If they've come to me before they've put an offer in, they're the clients that I want.
They're the ones, yep.
And telling them, right, okay, first things first, let's work out your servicing. Let's see what you can actually borrow. Because again, a lot of people, I had a client recently came to me, I'm putting this offer in, wasn't going to do it subject to finance, so I got that in there and said that, and she's like, yep, it's 850,000. I said, how much deposit have you got? Oh, well, we got a couple of grand. I was like, okay, what about your stamp duty? Well, what's stamp duty?
Hadn't factored it.
And I was like, you've owned houses before, you don't get those schemes, and that can be another thing where maybe they haven't paid stamp duty in the past because they were first home buyers, but no one explained to them why.
Okay.
So then they don't know what this $40,000 is that they're going to need at completion.
Well, that additional 5% tax on the purchase that goes to the government, a lot of people, I know there's a lot of people that don't facilitate that. So they just see the end price and they're not like working there.
Or a lot of times.
It can be a bit of a shock. I think that's where it's really important to have your numbers and all your due diligence done. So.
Exactly. And a lot of the time, I'll get asked, oh, well, can you not just put it in the loan? Well, no, unfortunately, that's where that LVR comes into play. So the maximum LVR that we can do on a property is 95 to 98%, including LMI.
Okay.
So that's of the property value though, that's what you're buying that house for. So that doesn't include your stamp duty, it doesn't include the conveyancing costs,
it doesn't extras that come with,
LMI, so your lender's mortgage insurance, which might be 10, 12 grand dependent on the property value. It doesn't include so I always tell people to have a little buffer, about $3,000 usually, to cover your conveyancer, loan fees, mortgage registration fees, the little things like that catch people out. So that's straight away have a $3,000 buffer just to cover you. And then that's where servicing comes in. We work out what can you actually afford to pay back? How much cash money do you need for this? Do you have to pay stamp duty? And how much you've got.
And then also, I'm tipping, look, we see a lot of first home buyers, and some of them are self-employed, for example, so they could be a subby, but they haven't done their tax. That tends to get them a little bit unstuck. Would that be fair to say?
I mean, as long as they're an established business, so for a lot of lenders, they require you to have been established for at least 2 years and GST registered for 2 years too. That's a pretty blanket rule. Look, there are some lenders that will do exceptions, but you'll be paying for it, essentially. So they don't always have to have the most recent financial year completed. Sometimes we can go off financials. So there'll be accountant prepared financials or software ones. Again, it's policy. I work a lot in the self-employed space. It's quite a big part of my clientele, but it's just working out, what might be better for this person. And you know what, that might not be the best rate. So I might have a self-employed person that really wants this house. They haven't done the latest tax return, but they feel like that by buying that house, it's going to grow enough, it's going to make them money, so they can have that higher rate, let's say for a year, until they're then in the next financial year, and then we'll look at refinancing them out. So you pay more for this year, but it's going to get you the house, you're not going to miss out on it. you know, and then come next financial year, we'll put you somewhere better.
Okay.
So there's always an option.
There's options.
Means
It's great.
to an end.
So you know, and that's great from a broker. Can I ask a silly question? What's the difference between the bank and a broker?
So, well, we're fantastic, obviously, but no, the difference between going to a bank and going to a broker is that if you go to a bank, let's say you go to ANZ.
Yep.
So you walk in there and you say, I want a home loan. Okay, well, here's your rate. Here's what it's going to cost. You know, we'll do some checks and we'll kind of hope that you can afford it.
Yep.
They don't care. All they want is that loan written out. So one, you've not got choice because you might then go into Commonwealth and they might have a better rate, or you might go NAB and, you know, they may have better terms or whatever it is. So you're limiting yourself by going to one bank. You're not giving yourself all the options.
You're not giving your options. You're not getting it's basically a all size fits all sort of scenario.
Yeah, and that's where having a broker, you know, we do that. So I've got access to over 60 lenders on my panel, and I can go through them.
So you got the conforming lenders, the big boys.
Yep.
So that's your NABs and your Westpacs, Commonwealth and ANZ, and then you've got your non-conforming.
Yep.
Who's at the moment a really good non-conforming that we would know of? Like,
I think it depends different things for different things. Wave money, awesome.
Wave money.
Yeah, so they're very much non-conforming. Yeah, yeah, they're very much in that non-conforming space, but they'll listen to you. You know, they'll hear your story, and that's what I like about them. You know, then these other ones that are working in that more construction space, like Odd Financial, La Trobe. So there's your big banks. You know, there's second tier lenders who they're kind of like your big banks, but they're not really. You know, your INGs and Macquarie Bank, who are really great, especially self-employed. You know, your Me Banks and things like that, and then we've got non-conforming as well. So
we're very fortunate to have such a diverse.
Correct.
What's really interesting? So, like, if you're buying an apartment and it's like, you know, 10 stories high. I only found this out because I was trying to sell one through one of the big banks, and they wouldn't touch it. And it happened to be the Bank of Queensland, because in Queensland they were used to all the high rise and all the lending up there. They took it on. So, is that normal? Are the big boys getting into that space, or is it more catered for?
So this depends on where it is. So these high density postcodes. And then there's high density living, which it's to do with how many levels are in that apartment block. So, you know, your Hawthorns and stuff where it might only be 2 or 3 levels, most will accept. When you go into like your Docklands, your South Banks, and there's, you know, they're the big towers. Sometimes the big lenders will take them on if they don't already have too many in there. So this is where it gets extra confusing. Wow. And again, this is why working with a broker and not a bank is always to your benefit. Because what they don't want is too much exposure. So
they don't want to put all their eggs in the basket and say it doesn't go well.
Exactly.
They're mitigating their risk.
100%, They don't want to have all that risk in that, you know, one condensed area when they can spread it out and, you know, a little bit here and there. And again, like I said, they don't mind, you know, your Armadales, your Hawthorns and things like that. The older unit blocks, apartment block things, but it's when it's those new big
ones,
city living.
And it's interesting. We're starting to see, like, you know, you look at Frankston, for example, 3199. Lots of big high rises are coming out, and it's great for the area because, you know, a lot of people are coming in and realising, geez, it's a great lifestyle and. What Franks has to offer. I mean, we just had the festival on the weekend and it was packed, and, you know, you got the Carlsberg
or the Beach Club.
The Beach Club. I haven't been there yet. I've walked past it. It was a bit too early for a beer at about 10 o'clock, but I think it was 12 o'clock somewhere. But no, it looks fantastic. I mean, I've always envisaged Frankston, you know, being a place where you know it's got that European feel. And it actually, look, you walk past and you know, having work. I know they're open Saturday, Sunday, and Mondays, I think. Unfortunately, Saturday's working a fair bit, but I think the weather and the summer that we're having, it's really good for Frankston to get that exposure. And really, I think it's still so undervalued.
100%.
for what it's got. So
I am the biggest Frankston advocate. Like, I will tell anyone. So, obviously, in my office at work, we're Little Collins Street in the city, and, you know, our brokers are from everywhere. We've got Queensland, we've got Victoria, and, like, ask anyone in that office, I am Frankston's #1 advocate. Like, I love it. Like you said, it's that European feel. Whenever family from the UK are over visiting, no one can believe, like, how there's just everything there, you know, it's so nice, like, there's just so much value there. And you know what, it did have a bad name in the past or whatever, but if you don't live in it day to day, then you don't see what it actually has to offer. And coming from England, it's like paradise. Like, you know, compared to what we have, it's such a difference. Like I will always praise Frankston.
It's got everything. Like we've you know, I say it in my auctions that 20% of the local area is actually reserves and nature bushland. So, you know, we've got the beach, the best beaches. We've got voted, you know, #1 beach in all of Victoria probably 3 or 4 times. So, and then, you know, I think what's really, we've found the investor market really dried up for a long time, which we can discuss from the lending perspective, but we found a lot of it, like the last probably 2 to 3 months, we've seen a huge wave of buyers coming from interstate, believe it or not. So buyers agents, buyers advocates, so they're flying in from Sydney, flying in from Perth, Brisbane to buy in Frankston. So I think one of the key things is the government and the amount of money that the government's pouring in. So the Frankston City Hospital is probably the jewel in the crown on the peninsula. So apart from Casey out in, you know, you've got the city of Casey, Frankston services all the peninsula. So we're seeing, you know, hundreds of millions poured in there. At the end of the train line, you know, we've got some of the best schools, best views. And then, you know, the next suburb over, you've got Mount Eliza where the medium house price is 1.6. And then you got, you know, you've got Little Frankston and Frankston South as the poor cousin. I firmly believe that gap's going to, you know, we're going to bridge that gap because more and more people are seeing the value that is here at the moment. So
100%. And it's funny, like you mentioned that the investor market. It's so from what I'm seeing, I guess from my side of things, is a lot of it's to do with these taxes as well. So there's that fear. You know, the government was announcing we're doing the short-term stay tax, the 7.5% levy. The vacant residential land tax. So for anyone that has a property that is vacant for more than 6 months in the year. And there was that fear in investors. Now, we were just recently told that Victoria is, what was it? The 5th most expensive state in the country. Now, what does that equate to? To me, that says cheapest.
That says cheapest. So, and I think, and look, I know some analysts have been predicting that Melbourne's on the rise. So, you know, look, I catch up with some local agents, some, you know, fellow directors and whatnot in the area, and we can see that, you know, Frankston's starting to bubble up. It's starting to come back, and I think we're starting to see some good growth. You know, and if you're upsizing, downsizing, it's a really good place. And at the end of the day, it's a great place to live. If you've got kids, if you've got your fur babies, you can go for a walk. You know, take the kids. Take your fur babies for a walk, go down the beach, and there's so much, and such a great community. So, you know, I think, you know, it does get a bad rap now and again. And look, you go anywhere in Melbourne at the moment, you know, with cost of living prices, we can see that there are some people on the fringes that are struggling. But one thing I will say, Frankston's got some really great people that are actually getting behind the people that are disadvantaged. Which is awesome. So,
and I just think there's so much opportunity. Like, being that we are the 5th most expensive, like, we got to catch back up. You know, we were never there. So, what is it now going to take, and what's coming in the near future for Victoria to pick back up again and to become back in line with, you know, our best friend Sydney?
You know, our best friend
Sydney. You know, we need to be back up there.
And that's the thing. Like, I think there's some really good, exciting things on the horizon. So even talking to the buyers agents, I'll say, guys, like, out of curiosity, you could have picked anywhere to buy. Can I ask why, Frankston? And they've said, look, affordability. 1, 2, the rental yield, amazing, because what you can get you can buy a property and it's nearly a 8 to 10% yield, whereas years gone by you'd be lucky to get 3%.
Yep.
So the yield's quite there. I mean, the rents have gone up, but people are affording it, and there's a lot more people. I think there was a stat that just came out in Victoria just recently where there was 20,000 less homes for renters because the rental market, the investors offloaded.
Yep.
And a lot of owner occupiers picked them up, which meant where are these? So that's why the demand and supply and demand. So the demand for rentals is quite high.
It is, and this is what's hard with these taxes that are coming in because, like you said, investors, they're offloading because of these taxes. So the vacant residential land tax, it starts at 2% of the capital improved value, so the value that's on your rates notice.
Yep.
So in the first year, it's 2%. Sorry, first year it's 1%. The following year it's 2%. The following and each consecutive year it's 3%. Okay. So in dollar value, let's say on a $800,000 property, that can be 20 grand in your first year, 40 grand in your second year, and 60 grand every year after that if you don't meet those requirements. And now there's quite a bit of there are some exemptions, but to meet those exemptions, like they've put things in there to make it hard. So first of all, even if you think you're exempt, you still have to report to State Revenue Office by the 15th of Jan every year. To be exempt, you cannot purchase, it has to be in your individual name essentially. So for these investors, and a lot of my investors do already purchase this way, they're purchasing companies or trusts, they're protecting their assets, but that can now mean that they are no longer eligible for that exemption, so they have to pay that tax. So that means that if, let's say they were planning on being a short-term rental, and they weren't rented out for more than 6 months in that year, they're up for that tax because they're not eligible for the exemption. So the only reasons you can get the exemption is if it's your principal place of residence, if the property is undergoing construction, renovations, or is uninhabitable. And again, that can only be for a period of up to 2 years. And then the other one is that either you or close family members use that as a holiday house for... It's at least 4 weeks in a year.
Yeah, that's right.
They don't have to be consecutive though.
Okay, I thought it was 6 weeks, but yeah, that's great to be clarified. Yeah,
it might be 6 weeks.
No,
4 or 6 weeks.
Yeah, I've had a client that said, they said that they're trying to get 6 weeks, but I think it's the 4 weeks.
Yeah. So they're putting those things in there.
Which is, I think, look, to be upfront, if you're buying property and unfortunately the entrepreneurs that have been doing that and establishing their portfolio, unfortunately, have been penalised quite heavily. And we've seen, I mean, as agents, we've had the benefits of being able to sell the investors' homes, and we've had a lot of investors say, look, we're starting to pile, we're getting these big bills. I had a client that came to an auction on the weekend of ours, and he came specifically to say, one, look, I need to offload because I owe a big debt to the State Revenue Department because of all the money that he's accumulated. So it's unfair because this guy was a guy that, to his credit, worked hard, was very savvy with how he went about investing. And now he has to offload quite a few properties. So. And
it's hard as well because it's a catch-22 because we need more rental properties, right?
We do, absolutely, yeah. But then, there's a shortage, yeah.
Exactly. So then investors are offloading and people are purchasing them owner-occupied. Yeah. But the problem is, for a lot of those people that are renting, they're probably not in a position to purchase. So we still need the rentals. So it's like you're penalising the people that are putting properties out there for that rental market, which not all of them are, don't get me wrong. And I think the short-term rental has really affected that in these recent years. And again, they've got another 7.5% levy on that. And that is not just on what they're renting the house at, it encompasses everything.
Absolutely.
So it's your cleaning fees, your
cleaning fees, and not only that, the compliance of now having an investment property, and they're talking about the conversion from, if you've got gas, converting it into electric. So there's a lot of variables at play. I think, it'd be interesting to see if a new government comes in and says, look, we're going to minimise or get rid of some of these items. That would be great. I think ultimately, you shouldn't be penalising investors. If they're wanting to rent out the property, they should be able to do it accordingly. I know that there has been landlords over the years that have done absolutely diddly squat, nothing to the property, and the poor tenants have had to pay a premium because if they complain, they're going to get kicked out. But you know, their heater's not working or this or that. So I understand that there should be regulations on how things are done, but don't penalise the investors. And I think that's probably the thing that I'm sort of I scratch my head over with some of the rulings. But at the end of the day, they are what we can't control it. You just got to move on. So.
And then going back to what you were saying about the buyer's agent as well. So I've got one of my investor clients works really closely with a buyer's agent, and I've know a few buyer's agents, and he was so set on most of his properties are SA, Queensland, Perth, because that's where the money used to be. And for the first time, he has now just purchased an investment property in Victoria, and his buyer's agent has just, you know, he's like, that's where the value is now. So they're moving.
The transfer of wealth. So you saw, I think in COVID, we saw a huge exponential growth. And then it was like, where's the other areas that need to catch up? And funny enough, Perth went through the roof. You know, South Australia that's really climbed high. And even the stats, I mean, we can show the stats on there of what each major city went about. Melbourne usually is top two. You know, we've claimed number one, you know, some years against Sydney's always right up there. But I've never seen us, like, after 2024 be as low as we have. And I can only see that's an indication that we're ready to bounce back in a good way. So we're seeing more investors coming in. Quick question: do you have many parents getting involved with their children's lending? You do?
Yeah. So we do work with parental guarantees a little bit. Again, right situation, they can be really good. Doesn't help with servicing, so that's more for your clients that they've got plenty of money coming in, they don't have the cash money to put in.
They don't have the deposit, because they might be renting, paying a premium, they haven't got the savings, so mum and dad pop it up.
So that rent is probably equal to, or maybe even higher than what
they're
going to be paying
for
the
I
mortgage.
was going to say, I've seen people that have gone, you know what, fantastic, we're getting a mortgage, it's actually cheaper than what we'll pay in rent. So. And that's scary, you know, because it's usually been the other way where it's been that way. What I was trying to, it's interesting, we've had a couple of situations where first home buyers are coming in and they'll say, oh, we love this home, that you know, the couple are, you know, besotted by this home, and then, you know, mum and dad roll up and, oh, we don't think you should be buying this, and they're just sticklers. So we're starting to see. We actually, I know Josh, he was dealing with the buyer, and he actually pulled up the purchasers, the kids, and said, hey, look, at the end of the day, you guys are buying the home, not your mum and dad. Now, I know they might be, but ultimately, you're going to do your due diligence, get your building and pass, but you're the ones living here, not your parents. If you love this, it's a house, go for it. Don't let someone hold you back. And we've seen a few situations where I think, I reckon in that situation, I said to Josh, I believe that they're giving a little bit of a parental money, hence why they're having a big say.
Or they may even be purchasing in with them. So sometimes they'll purchase a stake in the property to assist with servicing, to assist with deposit. You know, they may have heaps of equity in their home and they're putting that in. So sometimes they think they've got more of a say than they do. I think that's definitely more of a real estate problem. I don't tend to have to deal too much with that side of it.
It's look, you know what, we always say to clients, look, ultimately you've got to be happy with what you buy. We can't choose, we can facilitate the sale and present it. Ultimately, you've got to buy it and you've got to be content with it. Your mum and dad aren't going to live here, but if they've got a vested say, well then, you know, and we quickly ascertain, and we see that a fair bit at the moment. So, no, it's great.
Another thing that I'm seeing a little bit of at the minute is property share. So this is for. We're talking about your people. They want to buy. They want to get into the market. They don't really have the full deposit. They probably can't service quite enough to get in at the market where they want to. But maybe they have a best friend that they've been renting with for years and years and years. So what it allows them to do is to purchase into a property together with separate loan splits.
Okay, that's different. That's
they
cool.
essentially are responsible for their percentage of that property. Dependent on, let's say, one might have only a 5% deposit, but the other one has a 10% deposit. So then the loan is just adjusted based,
Yep.
and they buy a share in that property.
Okay.
So for, you know, your friends that maybe want to get into the market but can't really afford to on their own, and they were you'd be renting together anyway for at least the foreseeable.
Yep.
It's another way for them to be able to get into that
That's
market
interesting. Yeah.
without having to do, and it also allows them to have, you know, I mean, you can purchase together. You obviously have to get legal advice to be able to do that. But previously it was, you know, the one loan and the one repayment.
Is this a new thing that they've just brought out?
Yeah, so a couple of lenders are doing it now,
Okay.
and there's one really big one kind of in this space. But what they do is they have their own loan splits completely. So it's your own little loan repayment for your own smaller loan amount.
Yep.
And so you can have, you know, your own separate bank accounts. They can't see your bank accounts and stuff like that. It just really breaks it up. Really good opportunity for those that maybe aren't ready to just purchase one big house on their own. We've
seen a lot of siblings, funny enough, brothers and sisters buying in together.
Yep.
And it's just getting their foot in the door. I saw this happen probably 5-6 years ago. So there was a lot of siblings doing that. And then once the appreciation in the market starts to drive up, either one will buy them out. They'll you know, or say they've got a boyfriend now or a girlfriend. They're like, okay, well, yeah, we want to live here, or let's sell, or we'll buy you out, and they'll just
And this again is where it comes back to why you should use a broker and not go to the bank. So I've come across this a little bit where brother and sister, you know, they might purchase their first property together, you know, and now they want to keep that as a little investment property, but they want to go and buy another house with their husband, partner, whatever it might be. And for servicing though, that bank is already looking at them like, well, you're paying that mortgage, so how are you going to afford another one?
Yeah.
So there's policies in place whereby we can do debt apportionment.
Okay.
And what that means is that essentially the bank can assess them at only 50% of that loan amount that they're paying for that investment property. Whereas usually the banks will look at 100% of that payment because if the other person stops paying, you're liable for it. So using those policies is what again can make or break a deal for a person.
That's huge in the scheme of, like, if you look at it, most banks would look at that 100%. I didn't know that they would look at it and go, oh, well, you're in partnership, we'll go 50% rather than the full 100%. So
as long as you meet policy, then there's a few banks that are willing to look into that.
Wow.
And it just makes a difference, and it's shown like in stats as well. So I think the most recent one was that 75% of residential loans in Australia have been written by a broker.
Fantastic.
And that shows that what's
the stat there?
So that's like an 18% increase on last year.
Wow.
And I think part of that reason it's trust. Like they know that there's someone backing them and working in the right corner. And not just that, the due diligence of a broker, like, as you'd know, I've spoken to you about this lots of times now. But it's not just, oh yeah, I think you can afford that, you take that. No, we take the proper steps. We assess living expenses, we assess income. We think that comfortably, this is what you can afford. And when a bank then assesses that, so there's actually a 3% buffer that is put on by the bank. So let's say you're paying your loan at 6%, your new rate. When the bank assesses that, they look at your repayment as if you're actually paying it back at 9% to make sure that you can afford it.
Still afford it,
Now, so it's called best interest duty, and it's something that all brokers have to abide by. And we're regularly audited and things on that. Now, when you go into a bank, you know, just into a branch, they don't have those same best interest duty rules. So
very interesting.
Yeah, so it just shows you like people are choosing trust. You know, they're choosing a broker. They're choosing someone that's going to be in their corner.
Yeah, and that's look. I think that's when doing business, like in real estate, you want someone that you can trust, that you can know that you've got their best interests at heart. And no different as a broker, you want to be making sure that you're being looked after. You're not just being, oh yeah, we're going to put you into this loan, even though there's better loans available. So I think that's a pretty telling statistic. I think the big banks certainly, and I think, would it be fair to say the banks, because they're sort of diversifying, they've taken off a lot less tellers. When people walk in, and I see it, like as a business bank, I have to go into my business bank, and I've seen like you'll have one teller, but there'll be all these people lined up. And unfortunately, you know who the majority of the people are in the line? It's the elderly.
Yeah.
They can't, they're not electronically, and the poor things, they're going in to get their money.
Yep.
And they're told to stand up in a line, and they can barely stand up. They've got their, what you say. And so the business bankers aren't really, they're trying to get the loans, I suppose. So they're actually, I think they're shooting themselves in the foot, but I think in a lot of ways, brokers are going to really profit,
And I think part of the kick on of that is that banks are realising what brokers are doing. So they're like, we probably can take a step back. They realise that that's where most of their market share is coming from.
Yeah.
And they're probably, realising that. I don't know. But, it's funny. But you're right. Like, it's so hard to go in there and...
Well, the banks, to talk to a bank or even get on, everything's online, but there's not that personable service. And that's where I think people still need that, especially when they're taking a loan. And that's going to be what they're going to have to be, the repayments versus like and that person being the broker's caring, going, we want to make sure that you've got the best, you're going to put them in the best situation. Yeah,
and making sure that even if, look, it's very unlikely, but even if the RBA were to increase by 3%, on the 17th or whatever, you could still afford to pay that loan back. Yeah. It might be harder, but you could still afford to pay it back, and that's where those buffers come in, and that's where our best interest duty comes in. And I think, again, we're going back to that trust thing, and same for yourself. Like, you're the area specialist for Frankston. Like, you're the face, like, from what I've seen in the real estate market, because Frankston, you're involved in the community, you have that experience and those sales results which speak for themselves. So I guess similarly, when you're looking for a real estate agent, you're looking for that trust factor. You're like, I know that they can sell the house in Frankston,
Exactly. You got to know the area, whether it be, and Frankston incumbent's such a big part of the world. Like I've always said, there's like 5 little metropolises in Frankston South, and we cover all of it, which is awesome. So
there's Lakewood, Whistle Stop.
They've
got all the little.
You got Tony Lodge in Frankston South, and you got
the Pines.
You got the Pines. The Pines. Interesting. The Pines is an investor market. Yeah. But a lot of people that I know that I've played footy against back in the day, most of those guys have moved to Frankston South or Mount Eliza. So predominantly that used to be a commission-run home area. Still has commission homes, but that saw a huge surge. But must say I haven't sold one in there, I reckon, for about 10 years. So,
really?
Yeah. But look, you get clients that will look. For me, that area I probably wouldn't know, but it's a good part of the world, good people. Yeah.
Different market.
It is. It's a different market, and that's where you talk to buyers, and they're like, "Oh, well, we're looking for a strong, sturdy home." And I'll say, "Well, have you checked this price out or this area because it's a little bit lower in price?" Then you've got different price points, or the closer you are to Gould Street, houses there. Like there was a house in Frankston in Warringah Road. We've sold a couple on the other side. So Warringah Road's the cut off for Frankston South. Yep. And then you got Frankston. House up on the cliff there sold between 5 to 5.5 mil. Wow. It was a record for the estate. So, and then there's a big Spanish European home that's on the market.
Seen that one.
And that's going to get some really, once that sells, that's really going to help the area along as well. So there's some big properties that, and a lot of people are unaware of the spoils and riches that we have. Yep. It's a great part of the world to live in and be a part of. So.
Absolutely, I agree. I live here too, so.
Yep. Well, Jade, thank you so much for coming in. Do you have any questions for myself or?
No. How do we get in touch with you?
How do we get in touch?
For the people out there, how do we?
I was going to say, Jade, that's a very good one. For those people that are looking to get some advice on their lending front, hit up Jade. Jade will have her details. We'll have her details in the comment box, and certainly from that perspective, she's great at what she does. We've seen some clients really get serviced really well, and they love what you do, and it's fantastic.
Thank you.
No worries. Thanks for coming in.
No worries. Thank you.
No worries.